Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekend with musings that are designed to improve financial literacy around the world. Today is September the 20th, 2025. Over the past few months, we've explored compound interest, and we've traced banking's evolution from the Knights Templar through to the Bank of England's 1694 establishment. But there's another financial innovation that emerged alongside these developments, one so fundamental that we often take it for granted, and that is the development of insurance. Before stock markets or sophisticated banking, humans discovered something pretty profound. We are stronger when we share risks together. Today, we're beginning the story of how that simple insight evolved into the complex insurance systems that protect everything from your car to your life. So our story begins where you think it might, which is ancient Mesopotamia in 1750 BCE. Babylonian merchants faced a familiar problem: how to protect valuable cargo during dangerous trade expeditions. Picture a merchant preparing to send a caravan across hundreds of miles of dangerous territory. Bandits roamed trade routes, storms could destroy shipments, and floods might wash away months of preparation. Any merchant who lost a caravan could face financial ruin. Now, the Babylonians developed an ingenious solution that is recorded in the Code of Hammurabi, which we have discussed previously on the show. Merchants would pool their resources, agreeing that if any member lost a caravan, the others would help replace the lost goods. Each merchant contributed based on shipment value and route dangers. Bandit territory required higher contributions than more safer paths. Valuable silk cost more to insure than basic commodities like grain. The mathematics of this were simple but reasonably profound. Instead of each merchant facing a small chance of complete catastrophe, the group faced predictable patterns of manageable losses. They had discovered the fundamental principle underlying all insurance, which is, by pooling risks across many participants, individual catastrophes become collectively manageable expenses. Now, Chinese merchants were solving similar problems with remarkable sophistication. By 1000 BCE, Chinese traders practiced advanced maritime insurance for river and coastal trade. Chinese merchants developed what we might recognize as the first reinsurance systems. Large expeditions would be divided among multiple investors, with no single person bearing full risk. If a ship carrying silk and spices sank, the loss was spread among dozens of investors rather than destroying one merchant's livelihood. Even more ingeniously, Chinese merchants created rotating risk pools. Merchants would take turns sending expeditions, with the group collectively backing each voyage. This ensured successful traders helped support those who faced losses, while everyone maintained incentives to choose their routes carefully. These systems worked because they were built on mathematical principles that we've explored in our compound interest episodes. Just as compound growth becomes predictable over time despite short-term volatility, insurance losses become predictable across large groups despite individual unpredictability. Now, in medieval Europe, the same period when the Knights Templar were revolutionizing banking, craft guilds created another crucial innovation: systematic mutual aid societies. Medieval life was, as you might imagine, very precarious. A carpenter who broke his arm couldn't work for months, if ever. A weaver whose workshop burned lost both inventory and equipment. Without modern safety nets, common misfortunes could destroy your life. Craft guilds solved this through systematic mutual aid. Members paid regular contributions to guild treasuries, which provided support during emergencies. If a member died, the guild helped support his family. If someone's workshop burned down, guild funds helped to rebuild. Guild records show remarkably detailed actuarial calculations about life expectancy, disability rates, and fire frequency. The guilds understood something critical. Regular, small contributions accumulated over time could provide substantial protection against major losses. Now, by the 14th century, Italian merchants had developed what historians considered the first recognizable insurance contracts. Venice, Genoa, and Pisa were maritime trading powerhouses, sending ships throughout the Mediterranean and beyond. Italian insurance contracts were sophisticated legal documents establishing clear relationships between risk and price. Safe ports cost less to insure than war-torn regions. Experienced captains received better rates than novice captains. Cargo value determined premium costs. These contracts introduced concepts still central to modern insurance, things like deductibles, coverage limits, and exclusions for certain losses. They established that insurance fraud would void coverage and result in severe legal penalties. Most importantly, Italian merchants created the first systematic pricing of risk. They developed mathematical approaches to determine fair premiums based on historical loss data, ship quality, route danger, and cargo value. This mathematical approach to risk pricing would later influence everything from interest rates to stock market valuations. Our story reaches a crucial turning point with one of history's most devastating urban disasters. On September 2nd, 1666, a fire broke out in a London bakery. Over 4 days, the fire consumed approximately 80% of the city of London, destroying over 13,000 houses, 87 churches, and most major commercial buildings. This great fire created immediate recognition that Londoners needed systematic fire insurance. Individual property owners couldn't rebuild from such catastrophic losses, and traditional risk-sharing methods were overwhelmed by the scale of the destruction. Within years, the first formal fire insurance companies emerged. The Phoenix Fire Office was established in the 1680s, and Hand in Hand Fire and Life Insurance Society of 1696 offered standardized fire insurance policies to London property owners. These companies introduced professional risk assessment, standardized policy terms, and systematic premium collections. They hired inspectors to evaluate fire risks based on building materials, construction methods, and neighborhood fire prevention methods. Now, by the 1680s, all the pieces were in place for an insurance revolution. Ancient principles of risk pooling had evolved into sophisticated mathematical frameworks. Legal systems had developed to support complex insurance contracts, and urban growth created concentrated risks demanding systematic solutions. What was missing was a central marketplace where risks could be efficiently priced, policies easily traded, and information about losses quickly shared among insurers. That marketplace was about to emerge in a very unlikely location, a London coffee house run by Edward Lloyd. Next week, we'll discover how Lloyd's Coffee House became the birthplace of modern insurance, and in doing so created the mathematical and institutional foundations that would soon give rise to stock markets themselves. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services. Please like, subscribe, rate, and most importantly, share this public good with your friends, your neighbors, your colleagues, and maybe a family member or two. The show is produced by Nicholas Dempty. We'll see you next week on the Saturday Morning Muse.